Latin Resources has released the key outcomes of a preliminary economic assessment on the Colina Lithium deposit in the state of Minas Gerais in Brazil. Joining me today to tell us more about it are Chris Gale, Managing Director, and Tony Greenaway, Vice President of Operations, Americas. Chris, a very robust and compelling PEA released today. Please could you talk us through the numbers?
Yeah, hi Fiona, over here in Brazil, ready for a big couple of days at the Canaccord Mining Conference. It's about to start tomorrow. Fantastic numbers. Very, very proud of these numbers. You know, an NPV of 3.6 billion or $2.5 billion US, IRR of 132%, life of mine revenue at 12 billion, free cash flow of 6.8 billion, you know, annual production of 405,000 tonnes per annum, 5.5% spodumene concentrated, SCO 5.5. You know, it's just wonderful that we've been able to capture such. You know, we know it's a great resource, but for this to come out in the actual PEA we're just all very stoked here. You know, the cap expenditure $250 million US, that's a 7-month payback. So extraordinary numbers. And you know, the real, I suppose, interesting thing, this is all built around 26 million tonne of the 45 million tonne JORC that we have, because we can only use 75% of the measured and indicated and 25% of the inferred resource under ASX compliance for a PEA or a pre-feasibility study. So these numbers will grow as we work into our DFS. So we were really, really happy, over the moon with the numbers, actually.
Thanks, Chris. So you've used what seems to be a very conservative long-term spodumene price in the study. Can you explain the reasoning behind this?
Yes, look, who can pick the long-term spodumene price? We looked at all types of different numbers, you know, different analysis. The actual average spodumene price this year of spodumene coming out of Australia into China was $4,200 US a tonne. So, you know, what we've actually done is we use benchmark and fast markets for our pricing models. We've averaged those two, which they're the two leaders in their field for lithium prices. So we've averaged those out to long term, come up with $1,699, which we're very comfortable with. We think that's ultra conservative, leading into the supply-demand curve. The great thing for us is what we believe is then when we plan on going in production in 26, we're going to see a spike up in spodumene prices due to that extra demand we're going to see for EVs, storage systems, etc. So we've just been really conservative overall on this PEA, Fiona.
Thank you, Chris. The capex number of $253 million US seems like very good value based on the return on investment. Please could you talk us through that and also the operating costs?
Yes, once again, Fiona, operating Brazil is really a lot more efficient and I suppose a lot more value for money than building something in Australia or the US. So we're blessed to be in a great mining state of Minas Gerais, which, you know, have over 300 operating mines, a workforce. So when we break up the numbers and looking at them, the major cost, of course, being the initial mining costs of infrastructure around taking out the overburden, pre-stripping, building the pit. You know, that's up around $90 million, which will be sustained in the first year of operation. The process plant and the DMS units will actually be built in South Africa. They're modular DMS units where we will construct those units there. We will go through and commission those units in South Africa. We then pack that up, put it in a shipping container, move it across to Brazil. All the fabrication will be manufactured and we use local Brazilian contractors to put the whole plant together. That's up around $80 million. Then we move into the dry stack tailings, the recycled water systems, up around $30 million, site infrastructure around $10 million. And we've allowed a 32% contingency, which once again is really conservative based on what we know. You know, we've got real-time numbers from the contractors from Sigma plant. You know, we've allowed a $39 million contingency in that as well. So if we work on it hard and, put this out to tender, we might get this around 200 million US at the end of the day. So it's been a great, the costs, we're in a state that our actual plant will be provided by hydroelectricity. It's around 2 to 3 cents a kilowatt hour. So the all sustaining cost of $536 US a tonne is once again really, really feasible for us in making this. And, we're seeing it in the numbers of the IRR return. And that's using 120 tonne CRF number shipping costs to China. Our plan is to ship this material into the US and Europe, which we've got a cost around $80 to ship our material into the US, which means that basically we can get that number under $500 a tonne if we ship into the US. So once again, compelling numbers in all of that.
And back to that CapEx number of US $253 million, how are you planning on funding this?
Great question, and it'll be asked by a lot of our investors. So, look, as a lot of people know, we haven't appointed a offtake agreement or put an offtake agreement in place as yet. The plan now is in October we will send out expression of interest. We have about 22. I've just been to the Fast Markets European Raw Materials Conference in Europe, and we've put another 3 onto the list there, some car manufacturers out of Europe. So we have about 25 now on our list. We'll be putting out expression of interest to those people that are interested in taking the offtake. In October, we'll put that out. We would like to think that we would get some funding from that offtake, whether it be a prepayment of some sorts or basically a upfront payment to secure that material. So that's one area we're looking at. I'm in Brazil now. I have a couple of meetings with some development banks here in Brazil that have funded Sigma's portion of the project, so we'll take some debt on that. The whole idea is to try and get this project funded by debt and offtake and raise very little equity to actually fund this project. So we got plenty of time for that. Our DFS will be out in June. That's when we'll start looking at the funding round next year. So we're very comfortable that we'll raise that money. And it's not a lot of money in this scheme, on the whole scheme of things, in this particular sector of lithium.
Now turning to Tony. The mining model shows a ramp up of production over 2 to 3 years with phase 1 and phase 2. Please, could you explain this for us?
Yeah, look, certainly with any mine, there's a ramp up period from when you start to when you get into full production. So at the moment, what our mine plan contemplates is 2 phases. So the first one is a 3-year ramp up in phase 1, and then changing over to phase 2. So essentially what that means is we're building a plant with a front end capacity of 3.4 million tonnes. Then we have phase 1, which is our 1.5 million tonne throughput into the DMS, and that runs for 3 years. And then that actually pays off the capital to build phase 2, which is then running up to full capacity in the DMS plant. So we get up to our full production, and that runs out over the 11-year mine life. So as I said, it's 2 phases. So phase 1 at 1.5 pays itself off in about 7 months' time, and then phase 2 comes in that pays for that, and then we get up to full production after about year 3.
Thanks, Tony. Can you please run us through the mining plan, including the pre-strip and the resource to be used in the PEA?
Yeah, sure. Look, there's a bit to unpack in there, I guess. Maybe the first bit to start with is the resource. So at the moment, our main or our full Colina deposit is 45 million tonnes, and this PEA contemplates mining about 26 million tonnes of that. There are a number of reasons for that, and really the main one is a constraint that we have on us in terms of the indicated to inferred, or more so the ratio of the indicated to inferred resource that we can use. And because of that, what we see is a bit of a flat 3 years, and then we get this really big step up in year 4, where we're bringing all this material in. So that's not a realistic or a real sort of mine plan. It's an arbitrarily made one because of this restriction we have on us. So as part of the DFS, we'll be doing more drilling and we'll be changing that increasing that resource classification from inferred to indicated and measured. And that means we can schedule the mine a bit more appropriately, and we'll see a normal ramp up into years 1 and 2, and then flattening out over year 3 for that full sort of production profile out to the 11 years. So it's more of a realistic mine plan, and it's really, as I said, an artifact of where we are when there's a study. It's very early, a PEA is very early in the process. So that's one aspect of what we're doing. In terms of the pre-strip, at the moment it's 17 to 1 or waste to ore, which is fairly high. And one of the main reasons for that is as we move further to the southwest, we find that there's a bit of soil cover material and then a fairly deep weathering profile, and all at the moment where the mine schedule has all of that material coming off and going to the waste dump. As we move forward through the DFS, we'll be doing more drilling through that area, and we know that within that weathered proportion, there are some pockets in there and zones in there that have got really good grade. And so what we'll see is we'll be able to actually mine those and recover the spodumene from that. So that will lower the overall strip ratio. As we move it forward, and when we get more information, again, this whole issue is part of the fact that we're at a very early stage in a PEA. We've got a lot more work to do in the DFS, and as we go through that process, we'll have a lot more information to feed in to the mine plan, and we'll be able to make it a bit more realistic as to what we expect over the life of the actual mine.
And there's still a lot of drilling to be carried out at Colina. What does this mean for the DFS, which you've planned to complete in June of next year?
Yeah, so you're 100% right. We've still got 11 rigs on site drilling away feverishly, and I expect that to go all the way to the end of this year and through a lot of next year as well. I'm actually looking to increase that again if I can, to get another couple of rigs on site, and it'll have a number of focuses. Obviously, I've been talking about doing infill drilling within the resource itself to increase the JORC classification of the resource from inferred up to indicated and measured. And we need to do that as part of that DFS process. So that'll be one really strong focus for us. Within the existing resource itself, we'll be doing infill drilling to increase that JORC classification. But while we're doing that, we know that our ore body still extends to the southwest, and we've been doing a lot of drilling down there at the moment, looking to hopefully come out with a resource upgrade later on this year. So increasing from our 45 million tonnes to the south, we'll increase that to the southwest. We're also getting more ore at depth. So, stay tuned. Later on this year, we'll look to put that out. And our ore body continues on. So whilst we'll have a focus on infill drilling, we'll be extending our resource within Colina itself, and then also we've got things like Fogg's Block that we're still drilling, and that's looking really good at the moment. We're still waiting on a lot of assays to come in from that, but what we're seeing in the drill core is very similar to what we see at Colina, and I'm hoping to actually maybe get that into this next resource. We'll see how we go, but certainly we'll have a focus on that as well. So infill drilling at Colina itself, extensions to Colina itself, as well as targeting the new deposits that we hopefully will find. And as explorationists, we're always want to be going find that next one. So that's always going to be a big, strong focus for us.
Back to Chris now. Can you tell us a bit more about the fully sustainable mine design as contemplated in the study?
Sure. Yeah, look, this will be completely dense media separation. Apart from the tails, we've done some work on some spirals, and we believe that we'll be able to clean up the tailings, which once again reduces waste into a SC3, a 3% concentrate. So, it's just a great, I suppose, from our perspective, actually cleaning up the tails is taking more waste out of the operation. We'll have dry stack tailings, which has been designed, and it will be built, recycled water to meet the ESG standards. And the great thing about this project is that we all run by hydroelectricity. So when you look at that whole operation, it really is a fully sustainable mine design. On top of that, we'll add some battery power, backup, that type of thing. So, for us, it's going to meet a lot of those ESG standards that are required, and hopefully, we can start selling that material fully ESG compliant. into the markets of the US and Europe, which is very, very important to be able to sell that as a ESG product.
Great. And what are the next steps for the Colina Lithium deposit?
Okay, now we have our PEA out, so we've hit another milestone on time. We will continue to drill the project. We'll have another resource upgrade out before Christmas. We have started on our DFS, so that DFS we want completed by June next year, along with our environmental studies and mining permit application we want lodged by June. The government, the ministerialised government, are committed to having it approved within 6 months. So what we're hoping is to have our development application approved by December, along with our final investment decision. We would have been funded by that time. We want to start construction in first quarter of 25, complete construction in first quarter of 26, commission, and be in production by the second half, certainly by the third quarter of 26. A lot of people would say that's really optimistic. That I say to put, I've been in Europe with some funds, and they mentioned to me that seems very fast track. And I say, yes, it is fast track, but we have a precedent set in Sigma, who started construction of their plant in February of last year, completed February of this year, commissioned for 3 months, and they went into production in June. So that's a template we want to follow. Every consultant that worked on Sigma's projects working on ours. We're talking to the contractors that built the Sigma plant, which we hope will be working on ours. So it's just a great mining jurisdiction. Ministerised Governor Zema, who's backed this 100% to get us into production, it's just been wonderful. So we're going to make this happen very, very quickly.
And Chris, these are great production numbers you're contemplating. What does this mean for the state of Minas Gerais in Brazil?
Yeah, so touched on earlier, Fiona, Minas Gerais has 300 operating mines, produces a lot of Brazil's GDP in mining, has a tremendous workforce. We have a town of Salinas, which has 40,000 people. We've already got 60 people working on site at the moment. So we want to train those people within the local province of Salinas, who have been, absolutely so supportive thus far. So for Minas Gerais and the Governor Zema's, I suppose, strategy of building Lithium Valley in Minas Gerais, which is really, really now building into something special. Sigma's operating. They look at, they'll be producing around 750,000 tonnes of spodumene concentrate. We'll be up around to 500,000. We have an average of 400,000 tonnes over that 11-year period of mine life, which we hope will increase as we grow our resource. So with Sigma and Latin together in production by 27, we'll see Brazil propelled into, we believe, one of the top 4 producing countries of lithium in the world. So very exciting for Minas Gerais. And for us, it's just now getting focused on building the project and taking it to the next level.